There's really nothing that gives you that immediate gut punch, like logging into your brokerage account and just seeing a big red arrow pointing straight down.
Oh, absolutely. It's that feeling, right? Your stomach just drops.
It does. And your brain just starts screaming, what did I miss? What happened?
It's the sound of the panic button. And it's probably the oldest trap in the market. The second a price drops, emotion completely takes over.
And all that fundamental research you did just a week ago.
Out the window. Gone.
Exactly. Today, we're looking at Reviva Pharmaceuticals. The ticker is NASDAQ, RVPH.
Right. And last Friday, January 9th, the stock took a pretty significant hit.
It slid 7.10%, closing at a really tough 34 cents.
And that 7% drop is, well, it's the whole reason we're here. We're digging into an analysis report that actually calls this moment, this fear-based drop, a golden entry point.
A golden entry.
Yeah. So the mission for you, the listener, is to figure out which it is. Was this justified panic selling? Or is it what the analysis claims, a shakeout before the breakout?
That framing is just so critical. The title says it all, don't panic. Why the drop in RVPH is a BUY signal. The whole argument we're exploring is that this stock has hit deep value territory.
Because of a massive disconnect.
A massive disconnect between that 34-cent price and, well, the company's fundamental value and what Wall Street analysts expect. So our goal is pretty simple today. Move past the fear and focus on the facts.
Okay, so let's start by just, deconstructing that drop. A 7.1% slide on a Friday. That hurts. But the analysis noted something interesting about the volume.
It was low to moderate, which is a huge clue.
So if there wasn't a flood of sellers, what actually pushed it down to 34 cents?
This is where you have to remember the mechanics of these kinds of stocks. Penny stocks are often low float.
Meaning there aren't a ton of shares actually available to trade on the open market? Exactly. And when the float is low, it doesn't take a huge amount of selling to move the price in a really dramatic way.
So a small wave can capsize a small boat.
That's a perfect analogy. And the report really zeroes in on the psychological trigger here. Retail investors, they panic when a stock breaks below a known support level.
In this case, that was the 37-cent mark.
It was. That was the line in the sand. So once a few sell orders pushed it below 37 cents, it likely triggered a cascade.
A cascade of emotional selling, maybe some automated stop losses.
That's the critical distinction. And here is the single most important fact from the entire analysis.
Okay.
There was no fundamental news release on Friday, January 9th. Nothing.
So nothing to justify a 7% drop.
Absolutely nothing. No failed trial, no debt issue, no FDA rejection. So the move was driven by technicals and volatility. It was just noise, not a real signal.
That really changes the whole conversation, doesn't it? The price action screams panic, but the company itself was silent.
And that silence, according to the analysis, is the very first sign that this drop created an opportunity.
For a contrarian buyer.
Exactly. The first step is always to ask why the price moved. If there was bad news, we wouldn't be having this conversation. Since there wasn't, the analysis suggests this was just a clearing out of, the weak hands.
All right, so we've established the panic was likely driven by, well, nothing fundamental. So now let's get to the core of the report. The three pillars that argue why 34 cents is a massive buy signal.
Right. We're shifting from the noise of the trading screen back to the long-term value.
And pillar A is pretty startling. It's called the analyst valuation gap. The stock is at 34 cents. But where do Wall Street analysts have it pegged?
The gap it's huge. The consensus price target starts at around $2.38 on the low end.
$2.38, okay.
And it goes up to $5 or even more from the most bullish analysts.
Okay, I have to ask the skeptical question. I see 34 cents and I hear a $5 price target, and I immediately think, are these analysts just completely out of touch?
It's a fair question and a necessary one. The report clarifies, though, that these targets aren't based on, market hype. They're based on financial models.
Models tied to what?
Tied to the successful outcome of their clinical trials. They're projecting the potential revenue from their main drug, brilaroxazine, and then discounting it back to today's value.
So the analysis is basically saying that when a stock is trading at less than 15% of its analyst target, something is deeply wrong.
Or deeply disconnected. The market is acting schizophrenic. You have the short-term retail traders pricing in bankruptcy.
Zero value.
Exactly. And on the other side, you have the fundamental analysts pricing in clinical success and billions in future revenue. That gap is where deep value is born.
And that focus on clinical success leads us right into pillar B, which is the asset itself, brilaroxazine. How does that fit into this valuation disconnect?
Well, first, let's just look at the total value of the company right now. At 34 cents a share, Reviva's market cap is about $39.3 million.
$39 million. That is tiny, especially for a biotech company.
It's incredibly small. Now, consider what they own for that price. Brilaroxazine is their lead drug candidate. It's in late-stage trials, and it's targeting major conditions in the central nervous system space.
Like what?
Like schizophrenia. We're talking about markets worth billions and billions of dollars every year.
So the late-stage drug for a multi-billion-dollar problem. And the whole company is valued at less than $40 million.
The analysis uses a really powerful analogy for this. It says you're essentially buying a late-stage clinical pipeline for the price of a shell company.
It's like you're buying the land the factory's on,
Right.
but ignoring the nearly finished factory inside that's about to start printing money.
That's it exactly. If that drug is successful, a $39 million valuation is it's irrational. And that's how the report gets those potential 500% gains.
It certainly frames the upside, but there's always the big if in biotech. The best drug in the world is worthless if the company runs out of cash. Which brings us to pillar C, the cash position.
The elephant in the room.
Yeah.
The biggest fear for any deep value biotech investor is dilution.
That's when the company has to sell a ton of new shares at a low price just to keep the lights on, and it crushes existing shareholders.
Right. So what does the report show? Well, as of their last filing, Reviva had about $13.2 million in cash.
And why is that $13.2 million figure so important to this whole argument?
Because it provides a runway. It takes that immediate pressure of needing emergency financing right off the table. A lot of the panic selling you see in these stocks is because the market fears an imminent, painful capital raise.
But with $13 million in the bank,
they have time. They have the stability to keep operating and keep advancing brilaroxazine. It removes one of the key justifications for such a massive price drop on a no-news day.
Okay, so the fundamental arguments for deep value are they're incredibly strong. Let's pivot now from the company's story to the stock chart itself, because the analysis argues the drop actually created a perfect setup for a bounce.
It did. The technicals really back up the idea of an emotional flesh-out. That slide down to 34 cents has almost certainly pushed a key metric, the Relative Strength Index, or RSI, into oversold territory.
So likely below 30.
Very likely.
And for anyone newer to this, what does an oversold RSI signal, especially when there's no bad news attached?
It signals a technical extreme. RSI just measures the speed and change of price moves. When it gets slammed down into oversold territory without a real reason, it means the selling momentum is it's exhausted.
And algorithms notice that.
That's the key. Automated trading systems are programmed to spot these extremes, and they often trigger what's called mean reversion buying.
Yeah, so computers automatically start buying because the price has just fallen too far, too fast, without a good reason.
It's the smart money, or at least the automated money, betting on a snapback to a more rational price level. It's fascinating.
It is. It suggests the market's own mechanisms can recognize the irrationality of the move.
Precisely. And the technicals are also crucial for managing your risk. The analysis identifies a very clear boundary. The 52-week low for RVPH is 25 cents.
And how does that 25-cent number play into the strategy?
It acts as a hard floor. But more importantly for a trader, it's a very clear stop-loss level.
A line in the sand.
A line in the sand. If you're playing for that huge asymmetric reward, you have to define and limit your potential loss. Setting a stop just below your entry with a hard floor at 25 cents makes a potential loss small compared to the upside.
That clear risk management is a huge part of the action plan in the analysis. They label this a strong speculative buy. So how does the report suggest you approach it?
With patience. You don't just jump in at the market open. The strategy is to watch for the stock to stabilize, to consolidate around that 34-cent level.
And if it holds, if it finds its footing there?
Then the short-term targets come into play. Target 1 is just to get back what it lost, reclaim that psychological level of 38 cents, which was Friday's open.
And target 2?
Target 2 is the more significant goal, a full gap fill back up to the 45 to 50 cent range. That's where it was trading before that final wave of technical selling really kicked in.
That sets a pretty clear roadmap. But we have to end this section with a big caveat. We're talking about a stock trading for pennies. This isn't Apple or Google.
Absolutely not. And the analysis is very upfront about this. This is a high-risk, high-reward play. Volatility is, and I'm quoting here, the price of admission.
If you want those 500% gains.
You have to be prepared for 10% swings in a single day, up or down. This strategy is only for investors who understand that and have defined risk tolerance.
So let's bring this all together. The big takeaway from this deep dive is that the 7% drop was, according to the analysis, just a technical clearing out. It was weak hands getting shaken out, not a fundamental problem with the company.
Right. And in doing so, it created this psychological entry point defended by that 30 to 34 cent zone where smarter technical money is now expected to step in.
The synthesis really is that the market is offering you a gift.
It's giving you a chance to buy a potentially billion-dollar asset, brilaroxazine, for the price of a tiny shell company. all because of short-term, irrational fear.
You're essentially capitalizing on the market's own emotional breakdown.
That's the whole game for a contrarian investor.
And when you stack up the facts, the $13.2 million in cash, the analyst targets up to $5, the sheer size of the schizophrenia market. It makes that 34-cent price look, well, it looks almost unbelievable.
It creates a tremendous imbalance, a powerful asymmetry between risk and reward.
So we'll leave you with this final thought to really mull over. Given that huge analyst gap and the $13 million in the bank, how much risk are you truly taking if your downside is realistically capped at that hard floor of 25 cents, just 9 cents away, versus the potential 500% upside if brilaroxazine succeeds? That powerful skewed asymmetry is the entire concept that this deep value analysis is built on.